Hi, everybody. Thanks for tuning in today. Today, we're going to talk about SPACs. I still have some SPACs in my portfolio, and we're going to talk about five of them that I still own. And we're going to talk about which of them I like today for new investments. So, please subscribe to my YouTube channel if you do not already. And feel free to leave any questions or comments in the YouTube comments section, and I will do my best to address all of them personally. First, a little bit of background. We saw a ton of these blank check companies or SPACs go public in 2020 and 2021. There were days when over 10 of them went public in a single day. These raised billions and billions of dollars, and the goal was that each one of them would take that money and try to find a target business to bring to the public markets. SPACs have been around for a long time, but really gained popularity in the last few years. Some notable companies started using this method to go public. Virgin Galactic, which is ticker symbols SPCE, was the first one, and investors saw success of some of the early ones, and it just kind of led to a giant SPAC boom during the COVID pandemic. So, to put it mildly, there was a lot of speculation and irrational behavior occurring during the SPAC boom. And some of the companies that have been beaten down in the recent market turbulence deserve to be there. A lot of companies, with hundreds of SPACs going public, we saw a lot of competition among these companies to take businesses public. They started paying kind of outrageous premiums. Some of the projections that the businesses themselves made were, should we say, just unrealistic. So it is fair to say that a lot of the declines we've seen in SPACs are well justified. So that the first one I own, and I've done a video on this one recently, is SoFi. Ticker symbol is SOFI. It's short for social finance. They're the big banking disruptor. They started out as a student loan refinancer, but now they have a full range of online banking products. They have other types of loans, including mortgages, personal loans, credit cards. They offer deposit accounts. Their SoFi Money account offers both checking and savings functions at much higher interest rates than your brick and mortar bank likely pays. And they also offer a bunch of other products on the investment side. They have a brokerage, they have a robo advisor, and they're really kind of getting a lot of traction in their new products, specifically on the investing side and the SoFi Money side. So the long-term potential is huge. Nobody really likes their bank. If you use a brick and mortar bank, no one really is in love with their financial institution. So there's a lot of room to disrupt this space, and I do think they could be a big beneficiary of the new student loan plan we saw as payments resume in January. The student loan refinancing is still a pretty big part of its business. So with a $5 billion market cap, SoFi is down by roughly 37% from its initial SPAC valuation. It actually makes it the best performer of the stocks that I'm going to discuss today. And it's one that I've added to several times and plan to hold for a long time because their results have been fantastic. Number two, and this one is a little more beaten down. This is Nextdoor. A lot of people know Nextdoor as the neighborhood social network. Some people think it's a great place to communicate with neighbors and see what's going on in your community. Other people think it's a great platform to just go and complain about your neighbors. There are the user base has gotten very big recently. Over the past few years, most neighborhoods are in Nextdoor's system. Over 30 million active users. But the problem is its monetization is very small compared to other social media platforms. You know, when you think of companies like Pinterest and Facebook, the monetization is just off the charts better. Just like those, the primary way Nextdoor monetizes is through advertising, but it really hasn't figured it out totally just yet. So Nextdoor's losses are manageable right now, and the company has plenty of cash to build out its growth and figure out monetization. And I'm also a big fan of the company's leader. The CEO is Sarah Fryer, who was formerly chief financial officer at Square and had a lot to do with the success of the Cash App platform and kind of turning Square from a niche payment processor into what it is today. So, big fan of Nextdoor still. The third one, and this one is probably the most speculative of the three that I've talked about so far, is OfferPad, ticker symbol OPAD. They're one of the two publicly traded iBuyers, the other being Opendoor. And OfferPad is by far the smaller of the two. You can see their $389 million market cap after the recent declines. It's down well over 80% from its $10 SPAC valuation. Most SPACs went public at $10 a share in value. So the basic business model is OfferPad buys homes, makes repairs, and then sells them to buyers. Adds a lot of value for the seller. It makes the process easier. It can be a lot easier than listing a home, staging a home, holding open houses, negotiating, dealing with contingencies. So there's a lot of potential in the iBuying space. A lot of investors aren't sold that it could be a profitable, sustainable business. But there is over that's actually a typo. There are over $6 trillion worth of existing homes that change hands in the United States on an annual basis. So the market opportunity here is absolutely enormous if they can get it right. And of the two iBuyers, although OfferPad is the smaller of the two, it's also the more efficient and more profitable. OfferPad was profitable throughout 2021 and for the first 2 quarters of 2022. So they're doing a great job of profitability as well as growth. So that's one that I still own in my portfolio. Still a pretty small position because, like I said, it's a speculative company. I would call it. SoFi is by far the biggest of the positions of any of the SPACs I'm talking about today. It's the one that I'm most confident in. The rest are somewhat speculative. It's worth mentioning the bulk of my portfolio is in what I would call boring stocks. I'm a value investor at heart. I have a bunch of banks, real estate, and more stable companies in my portfolio, but these are just kind of the more, I consider them the more fun investments that I have. Another SPAC, this one was brought public by Richard Branson's Virgin Group SPAC. This is 23andMe. You probably know them for its genetic testing kits. It'll tell you your ancestry and things like that. The big investment thesis here is in pharmaceutical applications. The idea is that 23andMe has the best library of genetic material available anywhere, and it can leverage that to help create pharmaceutical products that are kind of either solve genetic issues or are tailored to to people's personal genetic makeup, and gives them an advantage over other pharmaceutical developers. Like most pharmaceutical stocks, 23andMe is losing money at a rapid pace, and this is just not the type of economic environment where you want to be a money-losing business. And its path to profitability really remains unclear at this point. This is a very binary outcome I see. If it's successful in developing some pharmaceutical products that do well, this could be a huge win, but it could also go bankrupt if it can't do that, especially at the current rate that it's losing money. And last but certainly not least is Latch, ticker symbol LTCH. This is one that I'm starting to lose faith in a little bit, if I'm being totally honest. Latch is a real estate company. It creates hardware and software products for commercial properties. Its revenue is growing, but the company is still pretty small. It's losing more money than it's selling. In the most recent quarter, its sales were around $13 million and its loss was about $44 million. So it doesn't have expenses in line. It's done a couple of rounds of layoffs since then and has taken steps to curb expenses, but it's likely to not be enough. And most alarmingly, Latch is growing in the wrong ways. It has two sides of its business. It sells smart home hardware like smart locks and things like that, and it loses money on those. The idea is that it's software products that link all of its smart home products together create a high margin recurring revenue stream. Well, in the last quarter, Latch's hardware revenue grew faster than its software revenue, which is not very good and not really what the investment thesis was in the first place. You can see this one's been beaten down tremendously, down about 90% since its SPAC IPO. Minuscule market cap. This one could go to zero if it doesn't turn things around pretty quickly. and it's one that I am considering actually selling at a big loss and getting some tax losses out of it. Again, all of these SPACs are relatively speculative investments, and some just didn't go the right way. But some people had been asking if I still like the SPAC model and if I still own any of them and if I still like any of them. So hopefully this video answered that question a little bit. So I want to thank The Motley Fool for being the sponsor of my video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 250%. Go to fool.com/Frankel to get your 10 stock picks now.